Bitcoin miners do not care about Core V30. I know that might surprise you, but we're here at the North American Blockchain Summit where roughly 30% of the world's hash rate is decided here in this building in Texas, and nobody has talked about Core V30. Welcome back to Bitcoin Season 2. So, Colin, we put on the suits. Well, you put on the suit.
I put on the sport coat.
It was a sport coat. But everyone else here is wearing like button downs, blue suits.
The occasional 10-gallon hat, which we love to see. It's very, very Texas coded.
Exactly. We're in Dallas, Texas, which is the money side of Texas, the
finance capital of Texas.
Finance capital of Texas. Soon to be their own stock exchange.
Yeah, it was a really interesting satellite event for NABS. That's what we're here for this week. Yesterday, there was a summit, and they were talking about the Texas Stock Exchange, which will be the first stock exchange to launch in the U.S. in a few decades. And there was funny in the programming. It was the Texas Stock Exchange had a panel early on, and then later on it was New York Stock Exchange and NASDAQ moving to Texas. Why? And it's like, well, there's a clear reason why New York Stock Exchange is coming here. Yeah. There's a kind of a center of gravity being shifted, especially for finance things, for things like oil and gas, data centers and Bitcoin mining, which, we're at the center of.
I mean, the data center energy here is crazy. The data centers are flying off the shelves, you could say, and they're building them as fast as they can. Everybody's just absolutely crazy over AI.
Everyone is talking steel, electrons, and aluminum. No one is talking about filters, spam, and Core V30.
In fact, I haven't even considered bringing it up to many people because I think the average person at this conference, and these are like decision makers for people who figure out how to deploy capital and build things that mine Bitcoin. I would say the average person has little to no familiarity at all with this conversation.
100%. And it brings me back to a question that I asked Blue Macellari. She's the head of digital assets at T. Rowe Price. I have an interview with her coming out on the Mining Pod next week. And I was like, how much do these investors know about technical discussions going on in Bitcoin? Because obviously we talk about filters and all this stuff on Writer's Room all the time. And she said they know absolutely nothing about it. Reminds me of when I was working at Luxor. They didn't, the pool itself, they didn't upgrade their node to Taproot for, I don't, like a few months, maybe a year, like maybe
and they're one of the first ones.
Yeah, exactly. Obviously all the pool is signaled, but like in terms of actually upgrading their node to the core version with Taproot, it took them a while because pools are very slow moving. In fact, I saw a lot of people saying that pools better not upgrade to core or they'll break Bitcoin. It's like, well, they're probably honestly not going to upgrade to it for a while anyway. They're not thinking about it.
Ask the average hasher, the average Bitcoin miner, what version of Core their pool runs. Nobody will know. Maybe one of their CTO people will be like, I know who I can call to figure that out. But as general rule of thumb, I would say a lot of people here don't actually know the difference between Bitcoin consensus and the client that you might use. So that's and that's not to say that these people are dumb or disconnected.
It's just Bitcoin has become incredibly siloed, and it is very hard to be a subject matter expert in all of these different silos. And miners are mostly worried about making money. This is one of the first misconceptions, I think, with some hardline Bitcoiners who don't know miners of what they're what they're incentivized to do or what their motives are. Most of them only care about making money. A lot of them aren't Bitcoiners. A lot of the most heavily capitalized miners are just suits, And
I think that's why they're so good at their job, because Bitcoiners, weirdly enough, you look at the discussion online and the whole discussion about filters is around assuming that people are profit motivated, and the filters discussion assumes that most miners aren't profit motivated, or I'm reductionist about I'm not steel manning that argument, but I kind of want to use this time to touch on a couple examples just to talk about how miners have come to look the way they currently do. And one of them is right now, a lot of the online discussion is talking about the large pools that exist. And one of the most conspicuous pools is the largest pool, Foundry. Roughly a third of the blocks per day, roughly a third of the hash rate in Bitcoin is pointed to Foundry. But how did Foundry get so big? Like, this is now actually almost like ancient lore for how Foundry got to be a third of the network. A lot of people don't realize like what incentives Foundry was giving to miners and why miners chose to point to Foundry in the first place. You lived during this. You like studied the industry and worked in the industry as this was happening.
I was there.
You were there.
I was the ballpoint pen in Mike Collier's pocket as they were signing deals with miners.
Exactly.
So this gets to also another, I think, point of misunderstanding, or at least a point of definition that's important. When most Bitcoiners, when they're talking game theory about mining and they say miners, what they're really referring to is mining pools.
Yeah.
Because the mining pools hold the keys to the kingdom in the sense that any hash rate that is pointing towards them, they control. So a mining pool aggregates hash rate, pays out miners rewards for their hash rate proportional to how much hash rate they have on the pool anytime the pool mines a block. That is the traditional model for a mining pool that Slush pool pioneered back in 2010, 2011. Fast forward to 2021, China's mining ban happens. The largest Bitcoin mining pools in the world are in China, Ant Pool via BTC, the Bitmain Mafia, BTC.com, F2 Pool, and Poolin. As hash rate migrates to the U.S., American pools start soaking up that business as miners in the U.S. start growing their dominance of Bitcoin's hash rate. And what Foundry did to attract a lot of them is it lowered their pool fees to 0%. Now, most pools will charge anywhere from 0 to 2.5 or 3% for taking on the risk of block variance.
And those are like
right?
their advertised rates, and then they would. I mean, it's common now, or at least it was common for a while, to like do bespoke deals to get like acquire hash rate.
If a miner had more hash rate, they would get a lower pool fee.
Like, okay, here's your account. We're gonna like make sure you get 0.5% lower because of
And the reason the pool fees are important is no one's going to give anything away for free, right? Or at least theoretically, because what pools like Foundry do, whereas a Slush pool, what used to be PPLNS, that's called pay per last end share. And that is a payment model where the miner only gets paid every time the mining pool mines a block, and then the miner is paid proportionally for their hash rate from those block rewards. Most mining pools now, including Foundry, do what's called full pay per share, which is that guarantees that they will pay the miner regardless of whether or not the mining pool wins a block based on a reference rate that we call hash price. So FPPS pools converge typically around the same hash price. There's not much variance. It's calculated based on the price of Bitcoin, how many blocks have come in under a specified period, transaction fees, all of these things. And so FPPS pools will pay miners regardless of how many blocks they hit based on hash price. And because of this, they're assuming all of the risk for block luck. If the FPPS pool mines a lot of blocks, if they have enough hash rate where they should mine 10 and they mine 12, then they get to keep 2 blocks worth of Bitcoin as profit. If they have 10 blocks worth of miners to reward and they only hit 8, then they have to make up that difference. So they're taking on risk.
They're kind of like banks or almost like insurance companies, and that they have to calculate like the risk of default, which is more like a luck risk.
It is mining pools are kind of insurance in that way. And when you put pool fees to 0, then you're basically making no money on that product. But that's how Foundry ended up amassing basically a third of Bitcoin's hash rate, is they offered a lot of these big institutional miners 0% fees on consistent revenue. And that last part's important because that gets to one of our other points, is like most of these Bitcoin miners don't want block variance and luck variance. They want to make sure they can know within a relative band what their revenue will be, months down the road. So,
and this was also, and it wasn't just that. It wasn't just FPPS. Like Foundry was also part of DC Digital Currency Group at the time, and it was kind of enmeshed in.
They would offer ASIC financing loans, so you could go to Foundry, who would find miners financing, and you would basically take on a loan, pledge your Bitcoin mining machines as collateral, and Foundry would service the loan. And then part of the deal was that you would then have to join Foundry's pool.
Yeah.
So. That's a common thing. Ant Pool does the same thing with.
But that what's funny is like that dynamic, which is common and has been industry standard in mining for a long time, for years now. I don't hear like people talking about that when talking about like pool and miner selection game theory.
Yeah.
They talk about this strict and monodimensional metric of how much does the pool pay me out per unit of hash rate that I give that pool, but they don't consider like service level agreements, agreements for financing, not through the pool,
ancillary
but through the
services that bring you in. You know, a lot of pools have, like Luxor's a great example. They have derivatives, they have energy stuff, they have ASIC trading. And so all of these firmware, all of these things end up becoming spokes in your wheel, and you know, they feed into each other. The mining pool feeds into the ancillary services feed into the mining pool.
It's funny because Bitcoiners talk so much about proof of work and how it connects to the real world, and that being a core like building block and backbone of Bitcoin security model. But it's as if we just like hand wave away all the other real world dynamics that go into Bitcoin security. And Ethan on the mining pod, which by this time this episode comes out, the mining pod will also be out. He had a good line, which is like, we have, you know, Luxor in particular is entering the new era of smart mining, where historically mining was kind of like you had a race car and it went at 60 miles or 0 miles an hour and didn't really have other kind of variables. And that's kind of almost like what the OG like PPL and S payout structure is for miners, rather than like a holistic whole package. Like you got to consider full cycle everything. Are you trading your power? Like all of these things come into play.
And zooming in on that, what Ethan's referring to is like giving miners the ability to more to curtail with more granularity, so they can power their ASIC down maybe by 50% instead of all the way, using firmware tools and miner management software. And I think that kind of illustrates where miners' heads are at. They live in the world of electrons and metal and minerals and physical infrastructure,
and deals with counties and utility companies and lobbying for regulators to do things.
Mining is the physical manifestation and the physical embodiment of Bitcoin, and it deals in physical space and with physical problems. Whereas a lot of the technical community obviously is dealing in cyberspace and the ephemeral,
hypothetical risk surface areas, and miners. It's actually kind of funny because Bitcoin design as a protocol is all obsessed with hypothetical attack vectors.
Yeah.
And mining, I would say as an industry, I would characterize as trying to mitigate real world, actual
100%.
imminent risk.
Hedging your power prices, making sure that you have insurance on your machines, making sure that your facility is weatherproofed.
Hey, Will here with Blockspace Media. Did you know that we have individual feeds for all our shows? If you're watching the Mining Pod, Bitcoin Season 2, or the Court Show, be sure to check out the individual feeds. You can find them on your podcast player of choice, whether that be Spotify, Apple, YouTube, etc. Just type in Blockspace Media and you'll find all our shows pop up, or just type in the individual show name like the Mining Pod or Bitcoin Season 2. Be sure to hit that subscribe and give us a 5-star rating so we can continue to bring you the best content in Bitcoin.
Going back to your original point that like profit motives aren't the only thing that drive miners. They're not, because, you know, a lot of the ocean guys have said, I mean, that is the thing. They were here to make money. But a lot of the ocean guys will say, well, ocean will pay X amount more than a FPPS pool. Well, again, part of the appeal for an institutional grade company that is trying to take out, you know, loans, trying to lower their cost of capital, trying to find ways to attract investors. They want to be able to say within a relative band of certainty how much their revenue will be. That's why they like FPPS, because they know what the value of their compute will be. They don't want that uncertainty, especially the public companies.
So that gets into one kind of mini topic, which is I heard someone at this conference say miners are still addicted to FPPS, almost kind of both lamenting that reality and kind of like, I don't want to say celebrating it, but like saying this is the reality, because this actually kind of gives mining pools a bit of a pain point. Mining pools over the past year, if you have been watching this and studying like what the mining pools make as far as revenue to the pool itself by pool fees, they've just been declining as a percentage of overall pool revenues. So like it's historic that a pool might say charge on average 2% a few years ago of revenues. And now it's probably far below that. And this actually kind of puts pools up with their backs up against a wall if that is their only business model.
Yeah.
Which is why you see all the, a lot of the pools. There's a lot of competition into vertical integration across services. But it's like you have this interesting scenario in the mining industry where, pools almost kind of would actually try to charge, actually make some money off the pool itself again.
Yeah, and a lot of them are starting to bump up their rates accordingly.
Yeah, Foundry was the first to do this.
And I do think going back to miners are so addicted to FPPS, there's not a better model. They're like Ocean and
there's
PPLNS are not, they're miners don't want them clearly. The market has spoken that they would rather have the revenue certainty. And I think that the only way that you can really solve for miner centralization within regards to FPPS is altering FPPS within the confines that make it interesting for miners. I don't know if that's possible. I don't think it actually is. I don't think that you can guarantee payment and not have the kind of concentration that we've seen. The only thing that I think might disrupt this in the future is when fees become a larger portion of block rewards, because I think structurally at that point, FPPS pools will not be able to guarantee that they can pay out those revenues unless the fees are crazy. And then if that happens, I think you might actually see a convergence back to PPLNS, because at the end of the day, no one's going to be comfortable if 80% of your revenues are coming from transaction fees and you don't know whether or not those transaction fees are going to account for $300,000 or $50,000. I don't know if pools are going to want to do that.
In my opinion, I've talked about this on this podcast and on my own social media for many years, is if Bitcoin does develop a fee market, as many of us assume that it should eventually, there's a scenario where pools, that is a disruptive force, which can shake up the mining industry again. And maybe we don't have PPLNS or FPPS. We have something which is kind of like a new animal,
hybrid,
where the operators of the pool now can actually leverage technical competence in pool operation, or transaction procurement, certain types of order flow, or just optimal technical implementation. Because right now those things haven't been terribly competitive. It's been a pretty flat space, but those type of things, that's why I got so excited about ordinals, because ordinals were one of the few interesting things that happened in that space, and I got all excited. Obviously, fees are rock bottom again now, but that could be a disruptive force. That could be a change. We could actually accrue some fee rates on Bitcoin, make it more competitive, which is funny because you don't really hear anybody who's talking about solving the pool centralization model. You don't hear those people talking about fees as a mechanism to do that.
Yeah. And a solution for pool centralization is not going to come from the technical community. It has to come from the mining community.
Yeah.
You know what I mean? And I just don't think that the people working in the technical space, they don't talk to miners enough. They don't understand what miners want or need enough to be able to actually architect a solution that's not just ham-fisted. And I think Ocean has kind of been an example of that.
It's funny because the hook for the podcast was miners don't know what's happening in Bitcoin, and now we're talking about how Bitcoiners don't know what's happening in mining.
True.
Yeah.
It's because these walls are very thick at this point between I think a lot of these different areas of development.
There's a huge disconnect between what is happening here with the actual decision makers and capital deployers,
and what happens at Op Next.
And what happens at Op Next.
Yeah, you know what I mean? I mean, seriously, though, there are all of these different Bitcoin conferences are clearly catering towards different sectors of the industry at this point. And I'm reminded of Bitcoin 2019 in San Francisco. And, it was Bitcoin conference is still big tent, but the focus was all over the place in 2019, and it still is with Bitcoin 2025. But that's still more like the cultural conference, whereas conferences like this are very industry focused, finance, things like that. So
Yeah, so we won't do too many mining related podcasts, but you got one today. Thanks for listening to Bitcoin Season 2. Make sure to check us out on all the relevant social media. Hit that like and subscribe. And we are giving away many bit axes the rest of the year. So keep checking our socials. See you next week.
Peace.